What's going on, everybody? What's going on, everybody? I hope everybody is doing well. Hope everybody is doing well. I know the people that really rock with me, they know that I came on a little bit late, but that's okay. That's okay. The task still has to get done. The task still has to get done regardless, right? The market was open today, so that was always a good thing. Always a good thing to see the market open. And right now, the stock market is trying to figure out inflation. That's what's going on right now. The stock market is trying to figure out inflation, but we've got a lot to discuss today. We've got a lot to really truly go through today. So I really truly appreciate everybody for coming on. Please bear with me as I get everything set up here. But yes, I really truly appreciate everybody for tapping in. The topic of the town is inflation. That's the topic of the town. Everybody is talking about it. Everybody is referring to it. But this is really truly going to be an opportunity for us to put some things into perspective about inflation, you know, and really truly understand that, you know, we don't want to be too affected by the noise. We really truly don't want to be too affected by the noise because we have to be long-term investors, and long-term investing is going to get us to where we need to go, right? So the more we stay focused on the long term, that's going to get us closer to the places that we need to go. So we're going to go through some things, go through the topics of the market, go through some macroeconomic data, because that's really truly what's necessary in order for us to understand that we need to get to the next level, right? That's really truly what's necessary for us to understand that we need to get to the next level. All right. So I won't hold anybody up any longer. So what's good, everybody? I appreciate everybody for joining another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So please like, please subscribe, please share this episode so we can get this out to multiple people. Please make sure you like the video. Please like the video. It's really, truly going to help me in the algorithm, and it's going to get more people seeing this video. Okay. On top of that, please hit that notification bell. So every time I come on live, you'll already be there. You'll already be ready. If you're interested in getting this t-shirt, don't pay for it, trade for it. Understanding that we need to invest and trade for the things that we want, please go to www.tradeforyourself.com, click catalog. You can see all the t-shirts that I have there. Okay. Look, just to let y'all know, free shipping on all items. Okay. Free shipping on all items. So please go over there, patronize me. If you want to buy 2 shirts, if you want to buy 3, 4, 5, it doesn't really matter. You know what I'm saying? Like, I'm just playing, just think about it, but today, we're really going to get in our episode real quick. One last thing I got to send out really quickly before we get into everything. But the title of this episode is "The Stock Market is Trying to Figure Out Inflation." Okay, what does that mean? The stock market is always working. Okay, the stock market is always moving, and the stock market is designed exactly the way it's supposed to be. Even though the market is down, even though we're in a bear market, the market is still operating exactly how it's supposed to operate. Now, we're going live, so this is an opportunity for you to get your questions answered. So if you have any questions, if you want to reach out to me in the chat, please come down and reach out to me in the chat. Let me know that you're here so we can pretty much, so we can have some type of feedback, have some type of interaction with each other. So First thing we got to talk about, and let me go ahead and share my screen really quickly here for everybody. We got to talk about inflation, right? Inflation is the buzzword. Inflation and recession, those are the two buzzwords, right? Everybody's talking about inflation and recession. So inflation rose 9.1% in June, even more than expected as consumer pressures intensify. So the consumer price index increased 9.1% from a year ago in June, above the 8.8% Dow Jones estimate, right? And so excluding food and energy, core CPI is 5.9% compared with the 5.7% estimate. Cost surge for gasoline, groceries, rent, and dental care. And adjusted for inflation, workers' hourly wages fell 1% during the month and are down 3.3% from a year ago. So let's put all this into context and really truly understand the consumer price index, right? It's a metric that is going to be released every single month to see how the price increase month over month and year over year, right? And it pretty much measures consumer spending money, right? 93% of the United States consumers are able to be captured into this metric. Now, understand this. This is what I want you to understand. Keep this in mind. This is a lagging indicator. What does that mean? Today is July 13th. We're looking at numbers that happened in June, right? And so the increase in the consumer price index was broad-based, with the indexes of gasoline, shelter, and food being the largest contributors. So the largest contributors for inflation is gasoline, shelter, and food. Now, the energy index rose 7.5% over the month and contributed nearly half of all the items increase, with the gasoline index rising 11.2% and the other major component indexes also rising. The food index rose 1% in June, as did the home index. Now, for the home index, we understand that we have a shortage of homes in the economy, right? We have a shortage of homes and homes are not going up as higher. But I'm willing to put it on the line that inflation may have peaked in gasoline and in food. I'm going to put this in context and show you why. Now let's go to the chart real quick and let's look at some things, right? Energy contributed to more than half of the inflation, more than half of it, right? And we're looking at numbers from June. We're looking at numbers from June, but now we're in July. At the height of the middle of June, oil was trading. Let me go to oil. Sorry, guys. Going to oil in the middle of June, oil was trading around $123 a barrel, right? Now oil has came all the way down to $96 a barrel. So now oil is down more than 22% from where it was in June. That is a big decrease. You can see now the gas prices are going down. The price of oil is going down. The energy, right? Energy, all commodities are coming down. Natural gas, a commodity in June, is down 32% since the month of June, right? Commodities. Okay, let's look at our corn futures. Our corn futures down more than 24%. Cotton down 11%. Copper down 22%, right? Another future, wheat futures, right? Down 26.74%. So we see these commodities that are continuing to come down. Now, that is going to help us from an inflation perspective, right? And so the one thing that I really truly liked about the stock market and what really truly got me into the stock market was talking about companies. I like talking about companies all day long, right? But in order for us to really truly understand and really truly be successful investors, we have to dig into the weeds and understand economic data. That's why the last 3, 4, 5, 6 weeks, for the most part, we've been talking about economic data. I've talked about Nike some. I've talked about other companies some, but next week we'll be getting into different companies and things like that, because earnings season is really truly ramping up, and so we'll be getting into that eventually. But just understand that we have to understand what this inflation is talking about. So let's go through this article on CNBC, and let's put some things into perspective, okay? Shoppers paid sharply higher prices for a variety of goods in June as inflation kept its hold on a slowing U.S. economy. The Bureau of Labor and Statistics reported Wednesday. The CPI, a broad measure of everyday goods and services related to the cost of living, soared 9.1% from a year ago, above the 8.8% Dow Jones estimate that marked the fastest place for inflation going back to November 1981. Excluding volatile and food and energy prices, so-called core CPI increased 5.9% compared with the 5.7%. Core inflation peaked at 6.5% in March and has been nudging down since. So that's important. Core CPI is continuing to come down, right? It's continuing to come down. On a monthly basis, headline CPI rose 1.3%, and core CPI was up 0.7% compared to the respective estimates, 1.1% and 0.5%. Taken together, the numbers seem to counter the narrative that inflation may be peaking, as the gains were based across a variety of categories. CPI delivered another shock, and as painful as June's higher number is, equally as bad as the broadening sources of inflation, said Robert Frick, corporate economist at Navy Federal Credit Union. Though CPI spike is led by food and energy prices, which are largely global problems, prices continue to mount for domestic goods and services, from shelter to autos to apparel. Okay, I understand that. The inflation reading could push the Federal Reserve into an even more aggressive position. Okay, traders up their bets on the pace of interest rate increases ahead. For the July 26, 27th meeting, a full percentage point move now has a better than even chance of happening, according to the CME's Group Fed Watch tool as of 10:40 a.m. U.S. inflation is above 9%, but it is the breadth of the price pressures that is really concerning for the Federal Reserve, said James Nottingley, ING's chief international economist. With supply conditions showing little sign of improvement, the onus is on the Fed to hit the brakes via higher rates to allow demand to match supply conditions. The recession threat is rising. Now, understand this really quickly here, right? The Federal Reserve has been continuing to raise interest rates. They've been raising interest rates really all year. And they've been raising interest rates because they're trying to control the inflation. Okay, they're trying to dampen the demand. They're trying to slow down the demand, slow down the price increases. And as we can see from these futures, right, these future contracts from these commodities, it's working based on what they're doing. Okay, now the Federal Reserve could raise 75 basis points and could raise 100 basis points, right? That's a possibility. And that would be a good thing with the July meeting, because the thing is like, let's just take it for example, let's just say, for the sake of argument, that June was the last high inflation reading, like that was the peak inflation reading, right? If the Fed decides to raise interest rates in July, the Fed won't be having another meeting until September. So what that means is that before the Fed meets in September, they'll see July CPI numbers and they'll see August CPI numbers, and they'll probably see they'll see July and August. They won't see September because the meeting is going to be in September, right? The meeting is going to be in September, so they won't see September. But they will see two more CPI readings before they get to September. So that will decide what the increase in the interest rates will be. But right now, I feel, in my humble opinion, that the economy can handle it. The economy just added 372,000 jobs. Our unemployment rate is still 3.6%, right? So yes, we'll probably be going into a recession. We will get the recession readings because recession is 2 straight negative quarters of GDP. We're probably going to get that. But there's a consensus out there. People keep saying the R word, recession, comparing this to 2008, saying the housing market is going to crash, and talking about Microsoft cutting percentage of employees and Google cutting employees and other tech companies cutting employees. I am not in the camp. This is not 2008. People are using the words recession and depression very interchangeably. They're the same thing. We're not going into a depression. We had a period of economic expansion 2020, 2021, and the stock market outperformed on a historical basis. We had some of the best returns that we had in the year of 2021. The thing is now is that the oversupply of money, we've got to regulate that thing back down. So the one thing I want to say is that even if inflation is peaking, doesn't mean that the volatility is over. No, the volatility is not over, because a lot of analysts are telling you that these earnings are about to be bad. And we're really, truly about to get into that starting tomorrow with the banks, JP Morgan, Morgan Stanley. Friday, we're getting BlackRock. So understand there's going to be a lot of volatility. Next week, we'll be getting Tesla, right? Stay tuned to the Trade for Yourself podcast next week, because we're breaking Tesla all the way down. Okay. Keep in mind, Netflix will probably be next week. Netflix just made a partnership with Microsoft for a paid ad subscription service. So understand what's going on here in the market. Do not get shaken out of your position. That's why I tell everybody to stay for the long term. Everybody will tell you it's doom and gloom. We are not going into a depression. We're going to a recession. Let's say that is a contraction in growth. We're coming down a little bit, but all hell is not breaking loose, y'all. Just calm down. Understand what you need to do. Understand your plan. Be calculating what you have to do and continue to buy stocks over the long term. This is an opportunity for you to be able to build a position, because volatility creates an opportunity. If you can only buy 2 or 3 stocks a month, and that's all the money that you have, you don't want to start to go from $100 to $200 in a month. You want to start to trade in a range and be patient and pick your spots. That way you can build that position, because right now in July 2022, we're in a bear market. We're in a bear market in the stock market, and we're going into a recession in the economy. But you got to understand, this is the time you got to plow. This is the time you got to plant. You got to plant these seeds in July 2022. You might not be able to reap the harvest until July 2025. But you got to understand and ask yourself this question: am I willing to do the work that it takes to get to July 2025, to see my future, right? To see the potential, understand what these companies have the potential to do. The bear market, the next bull market starts now. The companies that are preparing right now are going to be the ones that are going to be leading the next bull market. Your next big technologies are being developed right now. So just understand that and put that into perspective as we continue to go through these next few months. Now, like I said before, we're up across the board. Energy prices increased 7.5% on the month, and we're up 41.6% on a 12-month basis. The food index increased 1%, while shelter costs, which make up about 1/3 of the CPI, rose 0.6% for the month, and we're up 5.6% annually. This is the 6th straight month that food at home has rose at least 1%, and we're eating that at the grocery store. We're literally eating the cost, right? Rental costs rose 8.8% in June, the largest monthly increase since April 1986, according to the BLS. We have a shortage of homes in the United States. We're not building them up this fastly. They're just not going up that fast. And these renters, like the landlords, they're trying to get some money back from what they had to deal with back in 2020. So the stocks mostly slumped following the data, while the government bond yield surged. Okay. But still, even though the NASDAQ was down over 200 points and the S&P was down over 50 points, let's go to the chart real quick. Well, let's go to the chart real quick and see how the NASDAQ closed today, right? The NASDAQ was down big time. It was really, truly down big time today, right? In the morning, when that number came out, I'm going to break this down. Let's go to the 15-minute time frame, right? 15-minute time frame on the NASDAQ. You know what? Let's go to QQQ, because QQQ will give it to us a little bit better. All right, so if we look at QQQ, in the orange right here, this is our pre-market data. This is a 15-minute time frame. To put this into perspective, that is a big red candle, right? QQQ dropped from 290 all the way down to 279, and it was down there in the pre-market, but it rose up as high right, as 288. So we almost got back to the pre-market high, even though we dropped 3.7% in a 15-minute time frame. Now, what does that tell you? That tells me now put this into perspective. It doesn't mean QQQ is going to be up tomorrow, right? The futures are down right now on QQQ. The futures are down right now on SPY. Doesn't mean we're going back up, but put that into perspective. The market is going to price this in, and the market is going to figure out inflation before we will. The market knows some information that we don't know, right? Just in the same way that we, as retail investors or as investors in general, know some information that the market doesn't know, information that they haven't priced in, right? For example, I believe that Apple is going to be releasing some augmented reality and virtual reality glasses, right? That are going to take them into that next digital dimension, right? Really going to be able to pair well with the metaverse and understand the new technology that's coming ahead over the next couple of years, right? The market is not pricing in Apple releasing AR and VR glasses. The market's not pricing that in. So technically, the market doesn't know it yet, right? The market does know some information that we don't know because smart money is going to buy smart money buys, right? When the market is down. That's why I put on my Instagram story. Follow me at Mr. Devon Elder, MrDavonEoder on Instagram. I went live last Sunday. We're going to continue to go live, continue to put reels. I put the information out to the people. You buy into the weakness. You buy when the stocks are low. You buy when it feels like you probably shouldn't buy, but that's when you buy. That's how you get the best returns. That's how you have that growth that you need, right? So let's go back to our inflation. Let's go back into our inflation real quick. Much of the inflation came from gasoline prices, which I said before, I believe have peaked, which increased 11.2% in the month, just shy of 60% for the 12-month period. Electricity costs rose 1.7% and 13.7%, respectively. New and used vehicle prices posted respective monthly gains of 0.7% and 1.6%. Medical care costs climbed 0.7% on the month, propelled by a 1.9% increase in dental services, the largest monthly rise ever recorded for that sector in data that goes back to 1995. Now that's a big deal. Look at your healthcare stocks. I'm not very well versed in healthcare. I'm gonna be 100% honest with you, but I would like some healthcare people in the medical industry, especially my nurses out there, because I got some nurses in the family. And so I would like for y'all to let me know what's going on in the hospitals and let me know what's going on from a medical perspective so we can see what's going on. Airline fares were one of the fewest areas seeing a decline, falling 1.8% in June, though up 34.1% from a year ago. The meat, poultry, fish, and eggs category also dropped 0.4% for the month, but is up 11.7% on an annual basis. Telling you everything's up on an annual basis, right? The increases marked another tough month for consumers who have been suffering from soaring prices from everything from airline tickets to used cars to bacon and eggs. Now, airline fares were down. Okay, they saw a decline this month. And that was very interesting because I thought that Delta may have been able to have a good quarter, but obviously they didn't because these delays and these pilot shortages and these pilot strikes, right? And the lack of the employees at the airports, that's put a damper. That's really truly put a damper on the airline industry because we've had a lot of cancellations out there. So what that showed me was, to be honest with you, I don't really think Delta or American Airlines or Spirit, right? Spirit or Frontier or Alaska Airlines, like the airlines are just not an industry that I'm trying to be a part of. I will continue to watch it from an economic standpoint to see where we as Americans and where we as global society are spending our money. But somebody who does not manage money professionally, who is not a financial advisor, who is not a fiduciary, I would not be putting my money in airlines. There are way better industries out there, like a Pepsi, right? Pepsi, who had a good number on Monday. I could put my money there. Have a stable dividend, have growth, have pretty much have associated with brand recognition. That's where I want my money, right? So real incomes fall further. For workers, the numbers meant another hit to the wallet as inflation adjusted incomes based on average hourly earnings fell 1% for the month and were down 3.6% from a year ago. Policymakers have struggled to come up with an answer to a situation that is rooted in multiple factors, including clogged supply chains, outsized demand for goods and services, and trillions of dollars in COVID-related stimulus spending that has made consumers flush with cash and confronted with the highest prices since the early days of the Reagan administration. Federal Reserve officials have instituted a series of interest rates increases that have taken the benchmark short-term borrowing cost up 1.5 percentage points. The central bank is expected to continue hiking until inflation comes closer to its 2% longer run target rate. Now, that's a risk, right? The Fed's going to continue to raise those interest rates, but understand this, that is going to dampen the demand and is going to make borrowing money more expensive. So people are not going to be investing money pretty much that heavily. But like I said, as long-term investors, that's okay. That gives me an opportunity to continue to do my research and continue to find the satisfaction in the learning of the stock market. Finding satisfaction in the learning of the stock market so I can continue to move higher, right? Higher in my knowledge, understanding that there's a higher level that I can attain to, right? White House officials have blamed the uptick in prices on Russia's invasion of Ukraine, though inflation was already moving aggressively higher before that attack in February. President Joe Biden has called on gas station owners to lower prices. Lower prices, right? The administration and leading Democrats also have blamed what they call greedy corporations for using the pandemic as an excuse to raise prices. After-tax corporate profits, however, have increased just 1.3% in aggregate since the second quarter of 2021 when inflation took hold. In a statement following the report, Biden said, tackling inflation is my top priority, and repeated previous calls for oil and gas companies to lower prices and Congress to vote on legislation he said will reduce costs for various products and services. Okay. There is some reason to think that the July inflation numbers will cool. Gasoline prices have come down from their June peak. What have I said? With a gallon of regular falling to $4.64, a 4.7% drop for the month, according to Energy Information Administration data. The S&P GSCI Commodities Index, a broad-based measure of prices for multiple goods, has fallen 7.3% in July, though it remains up 17.2% for the year. That has come as wheat futures have fallen 8% since July 1st, while soybeans are down and corn is off 6% and 6.6% during the same period, right? That's what I'm saying. The major contributors to the inflation has came down. Now, it's going to take a while for all of it coming through the system. But with inflation coming down, and on top of that, the Federal Reserve really truly putting that stamp on inflation and bringing that thing down, we're going to get inflation down. Inflation is not going to 12% or 13%. We're not going to be dealing with runaway inflation because the investment into continuing to grow the economy is just not there. That's just something that we're dealing with. Now, let's talk about the view from the trucking industry, because this is very interesting. I've really never thought about the trucking industry and moving the transports, because the transports have been kind of weak this year from a stock perspective. So I kind of want to see what they're talking about here. So I see a light at the end of the tunnel. Brian Antonella, Senior Vice President of Fleet Operations for Fleet Advantage, a leasing and asset management company for the trucking industry based in Fort Lauderdale, Florida. Antonella expects production capacity to ramp up gradually, helping to create a more competitive environment for an industry that has failed the strain of rising fuel prices, a historically tight labor market, and the supply chain issues that have hampered the ability to get products to shelves, right? For probably 10 to 15 years before the pandemic, the industry fell into a stable routine where costs up across the board somewhere between 1% and 3% a year. It was easy to budget, it was easy to forecast, it was easy to build into the rates. The challenge we face today is not that 1.3% anymore. It's 10 to 20%, depending on what cost bucket you're talking about. Still, he said trucking companies are managing to get through with pricing power and creative financing. I do think people honestly are not trying to overcharge the customer. Antonella said they're not being predatory about it, but they are trying to find that fine line. What do we pass forward? How do we look at cost? How do we look at cost coming in? With the U.S. economic picture getting increasingly cloudy, he acknowledged that the industry is not recession proof. There are going to be challenges, Antonella said. I don't think it's all negative. I do think there will be challenges for the next 6 months, but I do think we're on an upswing. Okay, so we made it through the entire article, right? And there's a lot to digest. There's a lot to digest, right? There's really truly a lot to go through there. There's a lot to digest and there's a lot to go through. So as I get ready to close here today for another episode, I really just want everybody to put this into perspective. Okay. Put everything into perspective. Understand that the sky is not falling. Okay? The sky is not falling. We're going into a recession, which is an economic contraction, but that gives you opportunities. Opportunities come during recessions. Volatility creates opportunities. Yes, you may hear an article to say Microsoft, a $1.9 trillion company, is cutting less than 1% of its employees, right? Think about this for a second. Think about Microsoft, right? Microsoft, a tech giant. The biggest sources of its revenue, Microsoft Office, right? So your Microsoft Office, your Microsoft Word, Microsoft PowerPoint, your Microsoft Excel, right? Your Microsoft Outlook, Microsoft Teams, the communication for the enterprise client, everything for the communication that goes out that they use, they're using Microsoft, right? Microsoft Azure, cloud-based, continuing to store that data, right? Those are the main two revenue drivers that are enterprise-based. Look, I'm telling you, corporations are not cutting back that enterprise spend because they need it. They need it in order to operate. So Microsoft cutting less than 1% employees is a non-factor to me because the technology that Microsoft is already working on, they're already working on that technology. They're already working on that. $1.9 trillion businesses have the ability to pivot, y'all. They have the ability to be able to withstand economic downturns. Don't get me wrong. It doesn't mean the stock price will continue to come down. You've seen Microsoft's probably drop more than 30% this year. But you know what? It gives you an opportunity to buy a strong company with strong management, with strong growth prospects, with strong acquisitions out there, right? With a strong dividend, increasing revenue, increasing profit. That gives you that opportunity. Same thing with Google. Google is cutting down its forecast from hiring this year and next year. Understand what Google is. Google is an ad revenue machine. Google's getting ready to split their stock. That's going to give you an opportunity to buy this stock for less than $120 and continue to build that position. Google has a strong CEO, but understand that YouTube, right? YouTube and Google search, right? YouTube, Google search, and the Google Cloud. That's infrastructure that's already been built. They're going to continue to invest into it, but they may have a little slowdown, but it's not going to be a depression for the stock. On top of that, look at the technologies they're investing in. They own Waymo, an autonomous driving company. Waymo is a subsidiary underneath Google. That's telling you they're investing into the future. I watch those videos on LinkedIn all the time, and it amazes me. So when I sit up here and look at it, I understand that I have to be rooted in the long term in order to be successful. Like I said before, right? We're in July 2022, July 13th, 2022, right? The amount of work that you put in, the amount of studying that you put in, the amount of research, right? The commitment that you make. I'm not asking you to make a sacrifice for the stock market because it's my goal for you as a person, for you as a family, for you as individuals to be well-rounded in all areas of your life. I'm not asking you to make a sacrifice for the stock market. I'm asking you to make a commitment to it. Make a commitment to it. Understand that what you do, the seeds that you plant, right? The seeds that you plant, the field that you till. In July 13, 2022, the rewards are going to be reaped in July 2025, but it's going to take that time though. Like, what are you willing to do in order to be able to get there? Right. So as always, I appreciate y'all for tapping into the Trade for Yourself podcast. I really, truly appreciate y'all for coming through, listening to me. Okay. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every time I drop an episode. Okay. Look, if you want to get this fire t-shirt, if you want to be a part of a strong brand, okay, don't pay for it, trade for it. Please go to www.tradeforyourself.com and take advantage of the free shipping. Take advantage of the free shipping and get as many shirts as you need in order for you to be able to really truly rep this brand, really truly have it on your shirt and understand what this means. So next week, big earning season week. Understand that big earning season week, we're going to be talking about Tesla stock. Okay. So as always, remember, don't pay for it, trade for it. Catch y'all in the next one.